Do you want to know how to get started investing in fixed income? Then stick around till the end of this video. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How you doing today? I hope you are doing fantastic. I'm doing marvelous. And if you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I want to talk to you about fixed income investing. I love this topic. This is why I'm just very happy. And let's just get right into it. Why choose to invest in fixed income? Because as an investor, as a retail investor, you have options, right? You can invest in stocks. You can invest in real estate. You can invest in other alternative investments. But why fixed income? Benefits of fixed income investing include diversification. So, when you add bonds to a stock portfolio, this can help lower portfolio volatility over time. This is a fact. You also have capital preservation. That's another great benefit. So bonds typically have a stated maturity date. That's when the principal is expected to be repaid. The principal means that the amount that you lended to the company, to the bond issuer in the first place. Remember, when you buy bonds, when you invest in bonds, you're actually lending. You are a lender to the bond issuer. So every quarter, every 6 months, or every year, the bond issuer has to repay you a coupon payment. It has to make a coupon payment to you. So that's the interest income. And at the end of the maturity, actually not the end, at the end of the term, the bond term, that's AKA the maturity, you have to get back your principal, the amount you invested. So as a result, bonds are designed to protect principal, which can be useful when trying to save for future expenses such as buying a home or paying for college. Think about that, right? Another benefits of fixed income investing. Again, when I'm talking about fixed income, this is not just bond. Bonds are just one part, or just one asset within the fixed income category. You also have certificate of deposits. You also have government bonds such as such as the U.S. Treasury bills and U.S. Treasury notes. So income is also a great benefit of bond investing because fixed income securities are typically designed to generate a consistent stream of income. That's the keyword here. Keyword is income, but also consistent. And this consistency helps supplement an existing income or create one in retirement. What are the risks of bond investing? Because if you want to get started investing in fixed income, you got to really understand first what the benefits are. That's pretty cool, right? Awesome. But now let's get to the risks. So you have interest, credit, inflation, and call risk. Those are the 4 risks that you have to cope with. You have to handle when you invest in fixed income. Let me just quickly go through them because we have other shows that go in detail about the risk. But here I'm just going to sort of analyze them, I would say, very, very quickly. So interest rate risk. So when interest rates fall, bond prices rise. When interest rates rise, bond prices fall. So you have an inverse relationship. So you risk losing principal if you need money from a bond before it matures, and you have to sell it when the price is low. What about credit risk? This is the risk that a bond issuer will be unable to make interest payments or return your principal at maturity as promised. So if you have a bankruptcy or a company is having some kind of liquidity problems, liquidity stands for cash. So if you have some liquidity problems, then what we have in here, we have credit risk. What about inflation risk? This inflation can cause risk for bonds and investments that pay a fixed amount of income. So if prices rise due to inflation, for instance, but the interest payments you receive don't change, you lose purchasing power. And the 4th risk here that investors care about when investing in fixed income is call risk. So some bonds are sold with a call provision that gives the issuer the right to redeem, in other words, the right to call the bond and return the principal before it matures. So bonds are more likely to be called when interest rates fall, and the issuer can issue new bonds with a lower interest rate. So now that you understand the benefits and the risks, what about how do you really invest? How do you invest? Whether you plan to build your own fixed income portfolio or have it professionally constructed, understanding the steps involved can help you feel more informed moving forward. That's kind of important, folks. Don't take it lightly. So first, you got to define a goal. This is a biggie. You want to start by clarifying your reasons for adding fixed income to your portfolio in the first place. You have to know why you are doing this. Is it that you want to preserve capital? You want to diversify your portfolio or generate income? You also need to choose an allocation. What is that? So when you combine bond investments with varied maturities and credit ratings, you can create fixed income portfolios that align with various levels of risk and are designed ultimately to meet different financial goals. So what I'm trying to say here is that you have, because within the bond investment category, you have things like corporate bonds, you have investment grade bonds and high yield bonds, the lesser rated bonds. You also need to select ways to invest. So once you have defined your allocation, you want to consider the ways in which you might invest. So there are myriad ways to invest in fixed income. You can do like individual bonds versus CDs, for instance. You can do bond mutual funds versus ETFs. ETF stands for exchange traded funds or managed accounts. Why do you need to invest, or why would you need to invest in fixed income through a reputable broker? Again, I would recommend you going to a reputable broker. I'm talking about the Charles Schwab of the world, the Fidelity, the Franklin Templeton, all the big banks. They have a brokerage arms. You want to invest through them. You want to invest through them. And the reason is that if you choose a reputable broker, you can receive guidance and support from an experienced team of fixed income specialists, right? Because fixed income works in a different way than equity investment. So you want to have fixed income specialists sort of guide you, and they are working directly with the brokerage's trading desk to offer personalized assistance with things like pricing, for instance. If you have bond investing questions, they can answer that for you, and they can use a specialized criteria also to contact other firms to seek better prices on large block trades or securities. Let's say you have a windfall. Let's say you have an inheritance, or you won the lottery and you are risk averse, so you choose to invest in bonds. Then you might want to buy large block trades. You might want to initiate large block trades or buy large blocks of securities. In that case, you want to reach out to the fixed income desk so they can give you a better pricing level. You also have a wide selection of bonds when you talk to a reputable broker. You have a wider selection of bonds, bond funds and ETFs, CDs, preferred securities, and managed account to choose from. And you also have low straightforward pricing. And the great thing here is that if you have low straightforward pricing, guess what? You can keep more of your money, more ka-ching, ka-ching, ka-ching in your bank account. I'll be right back after this. Do not go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. We're also having a conversation here around how to get started investing in fixed income. Fixed income is great. It's a great addition to an optimized portfolio, and we believe that we have received a lot of questions from our community members, and we wanted to sort of address it. So if you love the quality of the content so far, please go ahead and smash the like button for me and turn on the notification bell so you are informed in real time whenever we drop a new show. And we drop this kind of shows every single day, wear no shine. Now let's talk about the what, where, and how of bonds. You got to understand that first. I talked to you in the last section. I talked to you about fixed income. So fixed income comprises bonds, but bonds are not the only fixed income securities, right? I mentioned CDs, preferred securities, managed accounts, bond funds, and so on and so forth. Now let's talk now about bonds. What are bonds? So when you invest in a bond, you are a company's lender, really. And the bond is like an IOU, a promise to pay back the money you have loaned, of course, with the interest. You're not, a philanthropist here. You're trying to make money, right? So CDs, states, the federal government agencies, and corporations, they issue bonds all the time, and they do it to raise money for purposes such as building roads and improving schools or technology. For companies, they might be expanding their operations. How are bonds bought and sold? The thing is, you can purchase bonds in the primary market, where newly issued securities are sold through underwriters or individual dealers to investors by the issuer. And the issuer here, as I just said, the issuer can be the federal government, a municipality, a government agency, or a corporation. It really doesn't matter. So when you buy a new issue In the primary market, you pay the new issue offering price, which is the same for all buyers. No difference here. Bonds can also be purchased in the secondary market, in which previously issued bonds are traded between dealers and investors, including institutions. So security prices are allowed to float at prices set by the market. So the market decides what the prices should be. So if you're considering buying a bond, you can search primary and secondary market offers for a bond. And you can go through your broker's account, your broker's client interface, or you can go to platforms such as Yahoo Finance or Bloomberg or CNBC.com to get the pricing on the bonds. What is the return on your bond? How do you calculate that? So when you buy a bond, here's the deal. So when you buy a bond, the quoted yield, the yield means return. When we talk about finance, when we have a financial conversation, yield is the same thing as return. So the quoted yield considers the bond's annual interest rate and any difference between the purchase price and the amount you are expected to receive upon maturity or issuer call. And this is called a par or face value. So when you hear terms like par value or face value, they mean the same thing when you're talking about bonds. So interest payments generally account for the bulk of a bond's return and are based on the bond's coupon. This is the interest received on a bond, which is usually fixed for the life of the bond, although some bonds have variable rates. We've seen that. And the amount a bond pays is largely determined by the prevailing interest rate and factors specific to that bond. So I was talking to you earlier about yield. Now I want to provide more info around the yield. I said the yield and return on investment, return, mean they are interchangeable terms. And so when somebody asks you what is a yield, the actual definition is that a bond yield is a measure of expected return based on its coupon, price, and other factors. So when we talk about yield here, we have an aggregate metric that not only depend I need to drink some water here. So I was just talking about a yield is an aggregate. If you think about it, an aggregate measure of expected return, and that expected return is based on the coupon, so the interest rate, the price of the bond, and other factors. The difference between coupon and yield for fixed income securities is pretty straightforward. So the coupon is the annual interest rate the issuer promises to pay the holder each year. And this is usually if you really you want to buy a bond and you go to the platforms I just mentioned, Yahoo Finance or CNBC or your broker's client interface, you would see that the coupon is usually expressed as a percentage of par value. Par value, again, is the amount the issuer originally borrowed and is obligated to pay back when the bond matures. And this is so the par value of the security. So the yield reflects the approximate measure of returns to the investor. So it's kind of like a yield and return is yield and return are like 99% close. There is a little bit of difference, and that difference has to do with the fact that you also have to take into account the price and other factors when calculating the yield. So what happens to your interest payments if rates go up and down? Because when a bond's price moves up or down, it still pays the same interest to the holder. Annual interest payments are calculated by multiplying the bond's face value by the coupon rate. One thing you have to understand is that payments are generally made in semi-annual installments based on the dates set in the initial POS. POS means the preliminary offering statement. This is what you get from the issuer, from the bond issuer, when you first pay the bonds, when you first buy the bonds. You can find details for frequency and dates of payments by checking your broker's client interface or by contacting the bond issuer. One thing that I want to mention, though, that I said semi-annual installment. Some banks, some bond issuers, some companies, some corporations make coupon payments every 3 months. They do on a quarterly basis, and some only do it on a yearly basis. So it all depends on the company. It all depends, really, at the end of the day. It depends on the environment and also the economic environment, but also on the industry. One thing I also want to explain to you when we talk about getting started investing in fixed income, you got to really be clear about the notion of accrued interest. So accrued interest is pretty simple. This is the interest that has accumulated since the last interest payment date. So if a bond issuer pays you coupon, it makes you coupon payments every 3 months. Basically, if they pay you on March 31st, and today we are like say May 15th, accrued interest is interest that has accrued from April 1st all the way to May 15th. So the seller of a bond is entitled to accrued interest, which is paid by the buyer and added to the price of a bond transaction. So accrued interest is calculated up to, but not including the settlement date. What determines a bond's interest rate? It's a great question. Now, credit, you have a few things. First, you have the credit rating of the bond. So a bond's interest rate reflects the issuer's credit risk, often issued by a credit rating agency, regarding the issuer's ability to make payments relative to other bonds. So the credit rating agency I'm talking about here could be one of three. So the three biggies, the three big credit rating agencies in the whole world right now are Moody's, Standard & Poor's, and Fitch. So, and generally, things work this way. The lower the credit rating, the higher the interest rate. Makes sense because investors expect extra compensation for greater risk. And that's totally logical, right? And besides credit rating, you also have to take into account maturity. So generally, the longer the maturity, the higher the interest rate. So investors in that scenario expect to earn more on longer term investments because their money is committed for a long period of time and unavailable for new investment. And the thing is, nobody knows the future, right? If I'm giving you my ka-ching, if I'm investing my ka-ching, my cash into your company by buying your bonds, and you want me to tie my cash into your company for 10 years, you better compensate me for the additional risk. So this metric, this component goes into the bond's interest rate. What is yield to maturity? You probably would have seen it. If you go on financial platforms and you're trying to research a bond, you will probably see the acronym YTM. YTM stands for yield to maturity. YTM is the annual rate of return assuming a bond is held to maturity and all of the interest payments are reinvested at the original date. And this is also known as the internal rate of return for the bond. So the terms YTM and IRR, internal rate of return, are interchangeable. And the last thing I want to talk about here first, before we take a break, is that sometimes you will hear things like discounts, premium bonds, discount bonds. So bonds are generally issued with a $1,000 par value. So when a bond's price rises above the $1,000 par, it is trading at a premium. And when a bond falls below the $1,000 par, it is trading at a discount. All right, I'll be right back right after this. Do not go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. I'm very happy you are still around. If you love the clarity and quality of the show so far, the content we are sharing with you, if you love that wonderful content, please consider subscribing to our channel and turn on the notification bell so you are informed in real time whenever we drop a new show. We drop this kind of shows every single day, rain or shine, we drop every single day. All right, and comment, share, and like this content. Let's talk now about the coupon. What happens if the coupon is higher than the yield? In other words, why can that happen? The bond is trading at a premium, a price above par, right? 100, because the yield to maturity on the bond is below the listed coupon of the bond. So whenever you have that, that's the explanation. So changing interest rates cause bond prices to rise and fall. For example, when rates rise, newly issued bonds must pay a higher interest rate to attract investment. This causes existing bonds with lower rates to fall in value because their payment rate is less attractive. That's the inverse relationship that economists and bond investors talk about when they talk about the price of the bonds versus the interest rate. You also have something called Y2W. This is something that very advanced bond portfolio managers and bond investors usually talk about. And the Y2W is the yield to worst. Yes, you heard it right. Yield to worst. This is the lowest potential rate of return for a bond. The lower of yield to call or yield to maturity. So whenever you hear that's the explanation. One thing you also have to understand is that I was telling you earlier that credit rating agencies, the three of them, Fitch, Standard and Poor's, and Moody's, they have different. They are the one who take care of I would say rating a bond, right, and an issuer's credit risk. And what they do is they have different calculations, even though in practice their calculations are pretty analogous, pretty similar. So what does the credit rating mean for Moody's or S&P? So an assessment of an issuer's ability to repay its debts based on its history of borrowing, repayment, and other factors. So if you hear, for instance, that one company is rated AAA, which is investment grade, which is like high quality, or is rated BBB, it means that the three rating agencies, or the particular rating agency that has issued the rating, has taken into account the issuer's ability to repay its debt based on its history of borrowing, repayment, and the other factors. Credit ratings are generally provided by an independent agency, such as Standard & Poor's or Moody's Investor Services, and are available through your brokerage client interface. Remember that ratings always reflect a current assessment of the issuer's creditworthiness and do not guarantee future performance. Now, if you want to, let's say you want to sell, you bought bonds. So I'm just still kind of walking you through how to get started investing in fixed income, and just kind of give you the premise of today's conversation. So let's say you've bought bonds and you've held it for a while, or you just realize you just made a big boo-boo and you want to sell them. How do you do that online? So your brokerage normally should provide the ability to sell most fixed income securities via their interface if there are sufficient existing market bids available, right? So if current bids cannot be found or do not meet the quantity for which you want to trade, you may also request that a fixed income specialist at your brokerage look for bids to sell your bonds or CDs. The great thing is that if you have a great reputable broker such as Schwab or Fidelity Investment or Franklin Templeton or any brokerage arm of one of the big investment banks such as Bank of America or JP Morgan Chase or Citibank, they will allow you, the fixed income desk at that brokerage will allow you to see all existing bid and ask prices for a bond on the market depth tab. You can sell your bonds on the interface online on the platform. You can request that your broker look for more bids if there are insufficient bids for your position. You can even receive an email alert when your bid is ready. So they will facilitate things for you. Can you trade a bond at a price listed on let's say on your brokerage statement or on your online account suggestion page, for example? The answer is, and a lot of investors are investigating that. Normally no, because usually the broker will show you. So when you have your interface, and you might have some differences here, but overall they are quite similar. The thing here is that the broker will actually suggest prices to you, will suggest bonds to you based on the bonds that are currently in your portfolio. And the thing is that they're not necessarily telling you that you have to buy, but if you want to buy them, you have to understand that the price shown, the price that you are seeing may differ from actual market transactions and should be used for approximate account valuation purposes only. In other words, it's FYI. Another important element that you have to understand when it comes to fixed income investing is that sometimes you hear the word matrix price. What is it? Matrix price and evaluated price are synonymous. So those are synonymous terms. So when you have an evaluated price or an estimated price for an individual fixed income investments, this is usually based on a pricing model that considers trades for similar securities, benchmark prices, dealer quotations, and other factors. So as a client, you cannot transact at the matrix price shown because it's just, again, FYI. If you want to buy or sell, you need to contact your broker to get an offer or bid on the bond. All right, I'll be right back right after this. Do not go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. We're also having a conversation here around how to get started investing in fixed income. And I want to just kind of wrap up things real quick here. The thing is, can you choose a price limit at which to sell your bonds? No. Again, no. Because the thing here is that most brokerages do not allow clients to place limit orders on individual bond securities. And there are many reasons for that. We have covered those reasons on another show about bond investing. So you might want to double check that show. What kind of fixed income strategy should you have? So I've talked to you about a lot of things regarding fixed income, how to buy, how to sell, how to identify your risk, why you should invest in fixed income in the first place. Let's talk a little bit about fixed income strategies. There are three important ones that sophisticated investors, bond investors use, or fixed income investors. So you have something called bond laddering. So bond laddering is a strategy that can help you minimize exposure to interest rate fluctuations. So rather than buying bonds that are, say, scheduled to come due during the same year, you can purchase bonds that mature at staggered future dates. We have an entire show focused on bond laddering. So besides bond laddering, you can also implement or talk to your portfolio manager to see if it is possible to implement a barbell fixed income strategy on your account, on your portfolio. So a barbell strategy does what? What it does is that, and that's pretty cool, it divides the allocation of bonds between, say, short-term and intermediate-term maturities. And it does that in an attempt to maximize the benefits of each. So the short-term bonds provide liquidity that can be quickly reinvested in new bonds when rates rise, while the longer-term maturities provide income. So for investors sidelined with a high proportion of cash, let's say you have 20% or 30% of cash in your portfolio, waiting for interest rates to rise, that's kind of cool because you can use a barbell strategy to work into a bond ladder over time. So as rates gradually rise, investors could add some intermediate to long-term bonds to the portfolio. So you have bond laddering, you have a barbell, and you also have another fixed income strategy called a bullet. Yeah, you heard it right. It is so fast, it is so lethal in a good way though. So what's a bullet? A bullet strategy when it comes to fixed income purchases several bonds that mature at the same time. So by targeting the specific maturity, the investor aims to invest in a particular segment of the yield curve, thus the term bullet. So though the bonds mature at the same time, they are all purchased at different times. All right, folks, this is it for today's conversation. I hope you learned a lot about how to get started in investing in fixed income. I will see you next time. But until then, remember, stay marvelous.